Thanks a lot for inviting me to discuss this paper. It's a really interesting paper. I enjoyed reading it. And sorry that font is smaller than I'd hoped. Apologies for that. The big picture question here is there a channel through which monetary policy operates as a result of investors kind of reaching for income? So is that an empirically relevant channel through which changes in the Fed fund rates might spill over into the real economy, influencing asset prices and then ultimately investments? And I guess there's an empirical question there, is it important? And then there's a theoretical question, which is, if it is important, should policymakers pay attention to that? Right? So that's kind of the end goal. The paper is about a bunch of things that kind of build up to that point, starting from household consumption. This question of, do investors, do they follow this rule of thumb of consuming dividends rather than capital gains? Again, at each level here, there's kind of an empirical question. Do we see that? And then a second question of, why do we see that? In the case of individual investors, is it the advice that they're getting? Is it behavioral in some way? Is it something that they're doing rationally in terms of their portfolio choice and consumption? So moving there is if investors do consume from income disproportionately ex post, then ex ante, should they use that in their portfolio choice? And there's kind of a static version of this. If we just think that dividends are very predictable, what would they want to do? How are they going to tilt their portfolio towards dividend-paying stocks? And of course, again, a theoretical question, should they do this? Why are they doing it? At least dividends are tax disadvantaged, so all else equal, you'd say maybe don't tilt towards dividends. Is there a reason that they're going, aside from, say, flexibility, there's another issue, maybe they shouldn't be focused on dividends at all because of their tax disadvantages. Moving from the static problem, this paper is really more about the dynamics. So the question here is, we think about how do they change their portfolio potentially over time, and how does that influence asset prices? And there are kind of two parts to that. Is if interest rates get really low, then maybe they want to adjust their portfolio, moving it towards more income-generating equities so that overall they can maintain their consumption plan. So that's first the empirical question is, do they have this dynamic portfolio choice where they move into paying stocks as a result of low interest rates? And then does that have an impact on asset prices if they're piling into dividend-paying stocks? Does it end up then that the price of dividend-paying stocks rises when interest rates fall? So this paper really touches on four different things. There's kind of two different empirical pieces and two different models. So there's really a lot going on in this paper. The main empirical stuff, they kind of have motivating evidence about, do investors consume from dividends, but then they kind of take that as an assumption and move forward to two empirical results. First is, do we see them shifting their portfolio? Do we see them buying and selling stocks as a function of interest rates or the Fed funds rate? Do we then see that spilling over to asset prices in a way that potentially there's a trading strategy that might take advantage of what individual investors are doing? And then they move to the theory. The first one is kind of over there on the left, is really about the static question, is should they use dividends in this way? And then there's a more dynamic model that allows us to think about differences in terms of interest rates and what would go on there. And then I think the monetary policy piece at the end is more just like speculations about what might happen. So a lot going on here, difficult for me to discuss all of these elements. I thought I'll just kind of give a helicopter tour of the paper and offer some comments along the way. And I'll kind of go through these four different pieces. So the first one here is we're kind of in this empirical one here is we're looking at household dynamic portfolio choice. Are they changing what they buy and sell as a function of the Fed funds rate? This is kind of a representative result in the paper. Is we look at a triple interaction in some sense where we're saying, investors who have a propensity to withdraw dividends, do we see them shifting their holdings away from dividend payers when interest rates are rising? I think I've got that right. It's difficult to keep it all track here, but that negative sign is kind of saying, alternatively, you could think about it, if interest rates fall, are they then moving into dividend-paying stocks? And what we see is a pretty strong effect here for these sort of rule of thumb consume from income investors, and we don't see the same pattern happening here. So, just a couple comments on this. It is surprising to me that this is about deposit rates. Just I think about that being, in one part of your portfolio, and maybe in your brokerage account, you might shift things around so that it provided a constant yield. But this view is sort of this holistic sense that I have a bank account, and then I have stocks, and I'm kind of trying to produce an overall level of income from those. So it's really coming, that's maybe CDs or something like that. I'm not sure what's going on. There's a statistical question here, which is just over this short window in the Schwab data, there's a question about like how much, do I really have a lot of independent observations there? I think this is where, aside from causality, the deposit rates, these are regional variation in deposit rate, helps with that in the sense that there's a little bit more cross-sectional information as well as time series. If it was just the Fed funds, I would just feel like there wasn't a whole lot of information we could get from that sample. There's an economic significance question in terms of, I really am interested in how much are they shifting the yield of their portfolio. Is this a big deal or a small deal? These are about transactions. I think we know in these accounts, most individuals just don't transact that much. So are we seeing something meaningful in terms of how much they're changing their portfolio? The next version of this is kind of to look at the level of mutual fund flows. So in this case, we're saying, do investors move from, say, growth-oriented mutual funds to income-oriented mutual funds to kind of offset some loss in terms of what they're getting on their fixed income portfolio. So here, what we have is, again, when the yield, this is all in terms of the yield going up, but in some sense, these negative signs are saying, when interest rates go down, what we see is investors moving in to income-oriented funds potentially to compensate for that. There's also this one where, it's around the stated names in addition to just whether they're generating income or not. Same sort of statistical significance questions here. This is a longer history, so that's a little bit better. Within that, because there does seem to be a fair amount of power here, I'd be interested in kind of seeing what the subsamples look like. I know that one really important period for income versus growth funds here was that late 90s, early 2000 period where you saw a massive allocation into growth funds and then a massive allocation away from them that I wouldn't necessarily think is about this particular mechanism. So kind of seeing how that comes out. The fund names is an interesting one. I guess this is really a sidebar from the paper, but it would be interesting to say, are the names relevant controlling for what the funds are actually doing? That would be an interesting result, although not super important for this paper. Now the question is, does it then spill into asset prices? So here, what they do is a particular version of it spilling over. It's kind of that I think what's going on here is that households are reacting with a little bit of a delay. So that if you're a trader, you see that rates fall today, you know that households are going to be moving in that direction, and for whatever variety of reasons that markets are inefficient, prices don't immediately adjust, so you want to kind of front run that household flow. And we see some evidence that at least to be consistent with that is that if I buy dividend payers right after a cut in rates, that suggests that the returns are going to be positive there. Some comments here. I think there's other ways that you could think about doing this. If we sort of set aside the market efficiency question, we could imagine just that there would be co-movement. That immediately on the rates going down, I would see kind of an adjustment in terms of dividend payers versus non-payers in anticipation, or because the households are reacting quickly. But we'd think of that as just a co-movement test that would be consistent with this. And if you were thinking in terms of inefficiency, you could also think of long-term reversal. Are these actually overvalued in some sense? Maybe a more substantive question is there has been a lot of focus in the last 5 or 6 years. Rates are very low. People are worried about if rates rise, what will that do to your stock portfolio? At least kind of in the investment management business, there's a sense of like, is there a risk to income sense or bond-like stocks if we see rates move up suddenly? Around the taper tantrum, there was sort of like a little episode where the cross-section of stocks kind of moved in this way. At least in my mind, I believe this income story, But I think it's a little bit broader in terms of the asset pricing. Is I would kind of characterize it more as like bond-like stocks, at least in my, when I've kind of looked at this question, I think there is an income effect, but in terms of trying to disentangle it, I think you'd find similar results, at least in terms of co-movement, with a variety of kind of bond-like characteristics. And even in risk models, you can think about what is the sensitivity of an individual stock to interest rates. I think dividends are going to be a good way to proxy for that. A couple of other things, though, like low volatility, low beta, and so on, are going to be there. Now, if you thought that kind of the controls here in terms of the Fama-French 5-factor alpha was going to get you that perfectly, that would be one thing. But my sense is that those aren't perfect proxies for kind of interest rate sensitivity. There is kind of a quality factor in the 5-factor alpha, but I'm not so sure that that's going to pick it up in the way that we'd like it to. So there, would be just interesting, not so much to control for these things as to do some placebo checks. If they all kind of line up the same way, I'm more inclined to think that this is about bond-like stuff rather than income per se. So now moving to the theory, so it's kind of reverses like, would we expect this stuff to happen? So there's kind of the motivating evidence about, do we see people consume dividends? What's the MPC from dividends? That is more motivating evidence for them. Given that it's high, is this a tool that we can kind of take advantage of? So the basic idea here is one, that my problem is that I know in the future I'm going to tend to consume too much. I want to tie my hands now. It's really a commitment problem. The solution here is if I know that ex post I'm not likely to consume anything out of principle, I can kind of tie my hands by fixing my dividend, the dividend yield on my portfolio ex ante. So just a couple comments on this. I mean, it doesn't seem like the best rule. I could think of better things to do. Endowments, if we're not thinking about transaction costs and so on, you think of like an endowment rule is similar to this. You don't want to overconsume from the endowment. On the other hand, there's a bunch of other things you're going to consider. You might set some target that only gets reevaluated occasionally to avoid the temptation to open up a bunch of new academic centers as a result of short-term movements in rates. Or the endowment's value. But you think about that would seem like a more sensible ex ante rule, but maybe it's hard to commit to. I guess I just wonder whether or not this dividends are such a strong commitment rule. This is for your entertainment value. If you're looking for commitment rules, there's a bunch of apps. Probably the most entertaining one is where you upload a very embarrassing photo of yourself to Facebook, and it's sort of a self-blackmail. If you don't do what you're supposed to do, then the picture gets revealed and all kinds of problems happen. So just do that. If you see me consuming more than this amount, please reveal that photo of me. Okay, so that's kind of the static question. The dynamic question is, a problem with the static model is I start off with good intentions, but now rates go down and I have this mix of fixed income and equities, and I'd like to get back to what was a reasonable rule. So I'm going to adjust my portfolio. Maybe I need to dynamically reallocate. I mean, a comment here is just, does that kind of undermine the basic premise then of the static model? If ex post I can reallocate for the reason of setting my consumption for the next period, what's going to stop me from just saying, I think I'll go and grab a little bit of that money and the capital gains at this point. I think other solutions here in this context, things like long-term bonds and TIPS would be kind of a natural thing to do. This is a bit distinct from, I think the distinction between reaching for yield and what the authors are calling reaching for income is the reaching for yield has kind of always been more about the fixed income market, I think, in general, and more about taking risk as opposed to, in this case, you might actually be de-risking your portfolio when you follow this. So it is producing some distinct effects. The standard channel would be kind of through bank lending. We'd expect the Fed either has some impact on real rates that kind of spills over through consumption or investment through the bank lending channel. Obviously a very important one that gets talked about a lot is what impact does it have on things like bubbles. That's more of a stocks versus bonds channel. I think of that as, if real rates are falling, that's going to push up kind of all assets and maybe risky assets disproportionately more in the reaching for yield sense. This paper, it doesn't emphasize this one as much, but there is this other piece. If you really are an income consumer, say from your CDs, then cutting rates is not going to be stimulative, at least for that set of consumers. They're going to have to cut back based on kind of the assumption in this model. So that's kind of going to be an offsetting effect that I think doesn't get emphasized too much. Maybe the capital market effects kind of offset it. And then this one, I think, is actually producing more of like it's unclear exactly what it's doing for policy, it's unclear exactly what to make of this. It's going to have some sort of second order effects in terms of shifting portfolios and so forth. Really, it will make payer stocks perhaps have a lower cost of capital. 0 minutes, perfect. Okay, so that's it. I like the paper. It's nice. I think the evidence on individuals trading in response to rates seems quite compelling. I'm not totally sold on the asset pricing impacts, that it's really distinct. I want to believe it, and I think it is something that's going on. It's just kind of hard to isolate. And there are a lot of things going on here. There's like 2 theory papers and 2 empirical ones. So